Good morning, everybody. Today is going to be a special show. We're talking about 7% interest rates again. Mortgage interest rates just went over 7% again. Not only are we going to talk about 7% interest rates and what you could do about it, we're going to be talking about how you can make it work for you. And in fact, in a lot of cases, 7% interest rates can be desirable if you know how to read an amortization schedule. And we're going to get into that today. But we're going to go even deeper today. Why are mortgages and other loans constructed the way they are? I'm going to show you something today that no one has probably ever shown you before. So you want to be here to get this information, to figure out why the banking system is the way it is. And you're going to learn something new about principal and interest payments today and why they exist the way they exist. It's going to blow your mind. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And the P.I.L.L Method show today is going to be special. We're coming right at you right now. Good morning, everybody. My name is Don Daniel, founder of P.I.L.L Method International, a better way to eliminate debt. And this is a special edition of the P.I.L.L Method show. We're going to dig down deep today. And I'm going to go over some things in the first 15 or 20 minutes to give you an overall view. And then we're going to dig down deeper into what we're talking about today. But right now, let me talk to you about this. I'm putting this on the screen so that you can kind of see what we're talking about when it comes to interest and how it is calculated and what's going on with the banking system. All right. So this is how you want to picture principal and interest. Principal and interest. This is a mortgage. This is a $200,000 mortgage. All right. And every month you pay, the way it's amortized, you pay a little bit more principal, a little more of your money goes to principal, a little less money goes to interest. Okay. A little more to principal, a little less to interest. So watch this. Do you see that in this line where you have the interest? Okay. The interest starts to go down eventually to zero. You're not paying any interest at all. And then the principal starts low, and towards the end of the loan, your principal payments go up until you pay off the entire $200,000. Now, this what we call is the rate of change. What is the rate of change? The rate of change is how fast does this change take place? The amount of money that goes to principal and the amount of money that goes to interest. So I need you to take a look at, we want to make sure that we understand what the bank is doing when they manipulate the rate of change. All right. So follow me on this one. So we're going to bring up a Brett Whistle here and talk about the rate of change. So we're going to put in this $200,000 mortgage here. All right. We're going to put it in at 6%. All right. And then we're going to calculate it. There you go. This is in Brett Whistle. All right. Let's get rid of this. All right. Now, here's what we're talking about as the rate of change. The amount of money that goes to principal is $199.10. The amount that goes to interest is $1,000. Okay. Now I need you to take a look at the rate of change, which is next month's payment. Next month, $200.10 goes to principal and $9.99 goes to interest. So the dollar that was going to interest is now going to principal. So that's the rate of change at this point, $1 a month. Look at the next month after that, $201.10 and $9.98. Then $202.10 and then $9.97. Now it starts to pick up a little bit more, $203.11 to $995.99. So the rate of change is now beginning to increase. So now, if you're a banker, you want the rate of change. Oh, good morning, everybody. I see you there, Israel. I see you there, Bayheart Media. Top of the day to you. I see you, Strategic Secrets. Start inviting some other folks in here. All right. We're going to have a great show today. The rate of change, if you are a bank, you want the rate of change to be slow. Why do you want the rate of change to be slow if you are a bank? This way, the faster this speeds up, your interest payments become smaller, faster. If you have, you don't have a rate of change that is slow. You don't want a fast rate of change if you are a bank. You want a slow rate of change if you are a bank. Conversely, you would think that if you are a homeowner, you want the rate of change to be very fast so that you start paying less interest early and more principal early. All right. So that more of your money would go to actually pay down the loan. So I need you to take a look at this. And then I'll get into it a little deeper after we get the basics down. Now, look at this. $199.10, $200.10, $201.10, $202.10. If you don't know how to read this, this could be very discouraging. Look how much money is going to principal and look how much is going to interest. I look at that, and some people look at that and they watch our videos here on at the P.I.L.L method, and then they pull out their paperwork from their mortgage and they look at that or they look at their statement and says, that's exactly right. Look how little money is going to principal, and look how how much money is going to interest. And then they look at it from month to month. They go back through their statements and they say, look at the rate of change. The amount of money that goes to principal each month is slowly gaining, and the amount of interest just hangs out there forever. Okay? Now, here is what I want to tell you, that when you look at this, the amount of money that goes to principal and the amount, listen, if you have anything to do with investing, if you have anything to do with banking, I need you to come to the show today. Come on into the studio and let's talk about it, because we're going to learn something today that you've never heard before. When you're looking at this, it is easy to come to the conclusion that when I make my mortgage payment, this much goes to principal and this much goes to interest. This much goes to principal and this much goes to interest. All right. And so, good morning, Shelley. How are you doing? Good morning to you. All right. So listen, that is not at all what is going on. Not at all. I want to tell you exactly what is happening here. When you borrow this money, okay, you are actually creating an account with a $200,000 deficit. a $200,000 deficit. There's a deficit there. And what you're doing is, or you're trying to fill it up. You're trying to get it from a negative $200,000, and you're trying to build it up till it reads zero. All right. Now, for the bank, they want this to be as slow as possible. When you understand it, when you really understand what's going on, then you're going to want what the bank wants. You want this to be small and you want it to be slow. This is what we call the rate of change paradox. What seems to be beneficial to the bank can be beneficial to you. What seems to be beneficial to you actually is not, when you understand what's really happening here. Now, let's just say that you are a real estate investor. Okay, you're a real estate investor, and this is going to become clear to you that when you're a real estate investor, and let's say I'm going to sell the property myself. I'm selling it myself. I don't want my person to get a mortgage. The person I'm selling the house to, I don't want them. They don't need to get a mortgage. I'm going to be the bank, because let's say I studied this thing, and it looks awfully tempting to me to have the payments come to me. Now, I need you to think about this question for a minute. The payment here is $1,199.10. $1,199.10. If I am the bank, if I'm receiving the payments from the person buying the house from me, how much of that payment comes to me as the bank? I'm the bank now. Of their payment, how much of that payment comes to me? I need you to put it in the comment section. All right. I need you to participate today. How much of that payment comes to me when the person who's buying the house, all right, the homeowner, when the homeowner is buying that house, or the home buyer, they're buying it from me, how much of that comes to me? $199. Bayheart Media, I used to believe the same thing until I thought about it for a hot minute. Okay. The banker receives all of the money, $1,199.10. The banker receives all of the money, not just $199, but they receive all of the money, all $199.10. Because of how this thing is constructed. And remember, when I started this, I have a $200,000 deficit. Out of that payment, because of amortization, only $199 out of that money is credited to the deficit. You see, all of this is paperwork in the background, but the investor gets all of the money. What does the rate of change actually do for the investor? This is what it does. Watch this. This rate of change actually means how many payments the investor is going to receive until these amounts that are credited to the deficit add up to $200,000. And the way that this is broken down is going to take 360 payments for this amount of money, these amounts of money, to counteract the deficit so that I can actually return all $200,000 to the banker, whoever the bank happens to be, whether it's Chase or whether it's the homeowner. The the person selling the house, they get all $1199.10. They get all of it. Now, If you prepay, all that means is the one selling the house gets fewer of those payments, $1,199.10. That's what that means. So the rate of change, how does that help me as the home buyer? How does a slow rate of change, a small rate of change, actually help me fill up my $200,000 deficit more efficiently, faster, and cheaper when the rate of change is actually slower? Here's what happens. When I have this $200.10, which is a small amount of money, and I prepay the $200.10, I don't have to pay them the $999 here. I get this for free. It doesn't cost me anything. I get to give them that money, and I just reduced the number of payments from 360 monthly payments to 359 monthly payments. So the rate of change being slower and smaller works for me, because if I decrease the interest rate, and we'll just make this 4%, okay? Calculate that. Get rid of this. Get rid of this. All right. I just decreased the interest rate. All right. Which gave me a smaller payment. And I've been taught to think that this is going to be better for me. So what did we just do? We just increase the amount that's going to principal, plus we decrease the amount that's going to interest, plus the rate of change is more. So I go from 288.16 to 289.12. So the amount of money that's going to principal each month has actually increased. It was just $1. Now it's more than $1 each month. And I get to fill that up faster if I make all 360 payments. But what if I don't want to make all 360 payments? I need you to see this, and it'll become clear. If I add up all of the principal payments here, it comes to $2,456 and a penny. Okay, that's when the rate of change is slow and the rate of change is small. Okay, I have a small number, and the rate of change, the amount of money that transfers from interest over to principal, is the slowest. In 1 year, I will pay this down by $2,456 and a penny and give the bank $11,933.19. That's what the banker wants. That's what the investor wants. If I was selling the house, this is what I would want. Okay. How many times have you paid me? You've paid me 12 months. And you filled up your deficit only by $2,456 and a penny. That's what I want as a banker. That's what I want if I'm selling the house, and banks love it, because all this means is you have to pay me. You've got to pay me longer just to fill up your deficit of $200,000. Okay. So how many times am I going to get $1,199.10? Well, let's see. Here's what I want. Okay. 11.99 times 360. Total $431,676. When the rate of change is slow and we start out with a small number, it's going to take $431,000 over 30 years to to fill up that deficit of $200,000. Okay. I start out with $200,000 deficit, and then I slowly but surely claw my way back up to the top where I give the bank their $200,000 that they're looking for, but it's going to take $431,676 of my money to do it. How do I know that? Because look here, I know that because they have to tell you at the beginning, when you sign this mortgage, you're going to pay back a total of $431,676 because of the rate of change. Now, what if we understood this from the beginning? All right. What if we understood this from the beginning? And so now, listen, I wanted to give you an overall picture of what's really happening in the first 20 minutes here. If you want to dig down deeper and figure out just exactly what the bank is doing behind the scenes, then we're going to use the rest of the show to dig down deep. So right after this commercial break with Dr. Eric Thomas, I'm going to come back and explain to you in detail what is going on here so that they get $431,000 when you borrowed $200,000. Be back in a minute.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
How would you like to be able to get this kind of information all the time? As a P.I.L.L method client, you don't just get our award-winning AI system, the cloud-based AI-powered computing platform that does all of the math, that guides you on getting out of all of your debt in an average of 7 to 9 years. You don't just get that. You also get this type of education so you can actually see what's going on behind the scenes and where all of this came from. We are an education company. Most people think that we're a technology company when we're actually education. You need to know, and you deserve to know what's going on behind the scenes. So go to ice10k.com, ice10k.com, and click on that button right underneath Dr. Eric Thomas's picture and get a savings and earnings report. You can know the month, day, and year you could be debt free. Not only that, but you get a lifetime of financial education that comes along with the program. Oh my goodness. You can teach it to your children. You can teach it to your grandchildren. You can teach it to, all of your young relatives. We didn't get this when we were young. Let's start the younger generation out with a true knowledge of what's going on and get information just like I'm giving to you now by going to ice10k.com, and then click on Get a Savings and Earnings Report. And it's free. You start with something that's free. Why would you not? Put all of your debt in: credit cards, car loans, student loans, 401k loans, loans from your insurance company. I don't care. Mortgages. Put it all in and see when we have a program that helps you to understand this rate of change and how you can use it to your benefit. Oh my goodness. You're going to love it. You're going to love it. Get this for free. And also, I need you to also click on, let's go back. Let me go back here. Okay. You see where this button here? Click on that button that says buy my book. Get the book and start teaching yourself and all of your young people what's really going on with these finances that we haven't been told since 1936, when the first self-amortized mortgage was introduced to the United States. No information, no education has gone forth from that day. Nobody knows how this thing works. Nobody knows. We're teaching it right here, and we're teaching it right now for free. But get the book so that you can start teaching this concept of understanding what's really going on behind the scenes to your young people. All right, get the book today. All right, look, let's get back into it. And now is the time to start breaking this down in detail. All right, we're going to go back. Okay, we're going to go back here. I'm going to bring up my other notes. Okay, and we're going to get into it. So we want to explain in detail principal and interest payments. So let's bring back our $200,000 mortgage at 6%. All right. And we're going to now, once we understand this, okay, Shelly, I see you. I see you. All right. We're going to break this down. And then once we break this down, I'm going to show you what 7% interest rates can do, because not only are you going to understand what the bank is really doing with this thing, but then you're going to learn that the 7% interest rates can actually be more beneficial than the lower interest rates if you can afford the payments. Okay. Now, how does the bank do this? How is this done? All right. So I'm going to bring up a calculator. Okay. There's two ways you can do this. Okay. How much interest and how are they calculating the interest and the principal? So we're going to take our 6% interest, 0.06, divide that by 12. Okay, that's the number we get, 0.005, 0.005. And what the bank does, or what an amortization schedule actually does, because an individual can be the banker. You don't have to go to Chase. You don't have to go to Wells Fargo. You don't have to go to any of these mortgage companies. You can actually buy your house from the person who owns the house. They can become the bank. I'm going to tell you now, when I realized that, I stopped thinking about that only this much went to principal and only this and all this money went to interest. And then I stopped to think and says, well, who collects all the interest? Am I getting this $199.10? Am I getting that? No, it's a credit towards my deficit. I'm signing some paper that says, yeah, I have a $200,000 deficit and I have to make up that deficit over 30 years. But because of how this thing works, I have to give them over $431,000 to create, to get back to zero. To get to zero, I have to give them $431,000. Now, that's the plan if you just look at amortization. But how can you give the banker, whether it's an institution or an individual, how can you give the banker back their money and make it impossible for them to charge you all of that interest? You can, Shelly. You can. Everybody who's watching this thing, you can give them back their money and make it impossible for them to charge you 360 times. If you want to know how to do that, you want to know more about this, because I'm starting it right here, but put some number 9s in the chat for me. Put some number 9s in the chat for me, and I will get into this thing deeper so that you can see what's really going on behind the scenes and how much money is being made here and how this whole thing got started. Okay. In fact, I've got in a few minutes, I'm going to put a link up that that the University of Pennsylvania did and put together an article on the mortgage situation the way it is now, and it started back in 1936. Oh, Brenda's here. Brenda's here this morning. She wants to see how this thing breaks down what they're doing and how you could take advantage of it. Now, watch this. We got 0.005, all right? And we're going to multiply that by $200,000. There it is, $200,000. It equals $1,000. $1,000. So when I do it the bank's way, this is how much is taken off the table, and it leaves only $199.10 to fill up the deficit. I give them $1199.10. Okay, my payment is discounted by $1,000, so that leaves only $199.10 to help me claw my way back up to zero from a $200,000 deficit. And I see your number 9 as well. Okay, so the next month, here's what's happening. When this $199.10 is credited to my deficit, Lord have mercy, then I get a new deficit. It's $199,800.90. What happens now? I got to take my 0.005, which is 1/12 of the interest rate, and now multiply it by my new deficit, okay, which is a brand new mortgage. 199. Oops, sorry about that. I get so excited. 0.005. All right, and we're going to multiply that by $199,800.90 equals $999. That my payment is now discounted by $999, and now $200.10 goes to reduce my deficit. Okay, so I can get closer to paying back the $200,000. Now, has anybody ever explained this to you before? Does this make sense to you? If this is making sense, put a number 7 in the chat. Put a number 7 in the chat if this is making sense to you. If it's not making sense, put a number 5 and I'll go over it again. Okay. But I need you to understand what's really happening here when you pay a mortgage. Okay. All right. Listen, Teresa says she gets it. All right. Israel says, listen, give me more information. You're going to get it. You're going to get it. Brenda Jackson gets it. So when you make a mortgage payment, ladies and gentlemen, each month is discounted by how the amortization schedule works, so you can fill up your deficit. All right. So now, what am I doing? If I give the bank money on my schedule, I can increase how much money goes to fill up my deficit without it being discounted. How would you like to be able to give them money and not have it discounted at all? Oh, Lord, have mercy. I don't want my payment discounted because I want to learn how to read this thing. I don't want my payment discounted. When I give them money, I want all of my money to go to fill up my deficit. Are you ready? Okay. Are you ready to hear how you can fill up your deficit? Okay. Because right now they want 360 payments. They want 360 payments to do that. Put a 360, put 360 in the chat. 360, that's what they want. Put 360 in right now, okay? Because we're going to learn the truth about this rate of change paradox. The rate of change paradox, we're going to fix it for you, okay? While you're putting 360 in, I'm going to go back to our image, okay? I want more of my money going to principal sooner. I want less of my money going to interest. All right. And so the paradox is I want the slowest. I want the slowest rate of change, and I want the smallest numbers. The slowest rate of change and the smallest numbers. Why is that? Because I can do more damage with the slow. Watch this, $200 here. So once you make your payment, you see, with a mortgage payment, you have to make a full payment before you can put money on the debt. Okay. And I'm trying to give you more. I'm trying to show you how you can have more control over this thing. All right. I'm going to show you how you can have more control over it with these smaller payments. Okay. When you make your payment of $11.99.10, and if you want to get rid of one whole payment, all you have to do is come up with $200.10 in the next month. If you lower the interest rate so that your rate of change is faster and you're working with bigger principal payments, watch what happens. Okay. Now, if I make my payment, which is less, my payment is less. And that's what I'm looking at. My payment is $954.83 instead of $11.99.10. But out of that, $298 goes to principal and only $665 goes to interest. And the uninitiated, the persons that don't know how to read this, they're going to get fooled in thinking that this is the thing to do. But if I make my first mortgage payment here and I want to get rid of one whole payment, now I have to come up with $289.12 to eliminate one line off my schedule instead of $200. Which one is easier after making a payment? $289 or $200? Is it becoming clear to you now? Is it becoming clear to you now that when the banks put things together so that they can make more money, the way they make more money is that we don't understand the system, because the very thing that they're using to make more money is the very system we can use to pay them less money. The very system that they're using. Can we use that system against them? Do you like this? Do you like what you're seeing so far? All right. So if I give them the $200, I get rid of this. Boom. So 1 year's worth of principal payments comes to $2,456 and a penny. I could take 12 whole months of these $200 payments to give them the $2,456 in 1 year and pay $11,933.19. My payments get discounted by $11,933.19. So what do I mean by that? Okay, here's what we're talking about. We got $11,933.19. That's how much the discount was, plus the $2,456.01 equals $14,389.20 paid out, but my payments were discounted by $11,933.19, which means only $2,456 went to my deficit to fill it up so I can claw my way back to zero. Is it becoming clear? So this is what they want, but I'm going to show you this is what you want as well. Okay? Because what if I gave them this money up front? I make my regular mortgage payment, and if I had it, I could give them the $2,456 and a penny all at one time, and I could be paid down to here in 1 month. And my next mortgage payment is based on this number, not this number, because I gave them all of this money at once. So I'm paid down to here. So now what does the bank have to do, whether it's an individual or whether it's an institution? They have to take their 0.005 and multiply it by this new number, which is my new mortgage. Okay. You see, each one of these is a separate mortgage. It's not just one mortgage. Every time you give them money, it creates a separate mortgage. So if I give them all of this money at once, here's my new mortgage here. So let me multiply it by 197,543.99 equals, did I do that right? Yeah. $987.719, which means because this is a 9, I have to increase this one to a 2. So 987.72. This is my new payment here. I just increased the rate of change more rapidly by using the small rate of change that they gave me. Give me a small rate of change, and listen, I'll beat you back to zero all day long. Watch this. So now, instead of giving them $999, they're going to get $987, and they don't get any of these. None of these. That is every interest cost between line 2 and line 12 have just been canceled because I have a small rate of change and small numbers to work with. But because I have a small rate of change and small numbers to work with, I can eliminate more interest and more payments because of this system that is supposed to work against me. This is why, listen to me now, I'm looking straight into the camera at you. This is why you're never supposed to know how this works. It's not taught in junior high. It's not taught in high school. It's not taught in college. It's not taught in grad school. If you are a business major, it's not taught to you either. If you are a real estate agent or a mortgage professional, it's not taught to you. If you're a CPA, this is not taught to you. It's only taught here at the P.I.L.L method. And you get this kind of training for the rest of your life with our lifetime program. Our program is a lifetime program because we have to counteract all of this bad information we've been given about how money really works. Nobody else is teaching this. The P.I.L.L method is teaching this. And listen, and this is what excites me. This is why I'm on the planet. I was just talking to some folks from church yesterday, and it was mentioned that I should tell more people that I have ASD, autism spectrum disorder. It is, some people call it Asperger's. When I see an amortization schedule, this is what I see. And my brain is wired that way. Nobody taught me this. It is a gift from God that I can do this, and I'm sharing it with you. So they said, Don, you need to tell more people. Why do I need to tell more people? I don't know, because it was told to me that there may be parents out there. There may be adults. There may be children that might be struggling because they have ASD. And they don't know that there is a positive future for them. Listen, folks, this is what I'm good at. This is what God gave me. And so I'm giving it to you. And listen, this is my thing. And I'm finding out new things about it all the time. The more I look at it, the more I share, the more I get out of it, and then I can share more again. So can you do this? If you're not, if you haven't subscribed to our YouTube channel, please do, and share it with others. All right. And give this information away freely. All right. So if we get back, let's get back to this thing. And so if you need a speaker at your church, at your, your civic meetings or whatever, contact the P.I.L.L method at this number, 256 886 1867. We're going to put it across the screen. 256 886 1867. And you can get me to come to your church to speak to your people about ASD, about how I've overcome it, what I'm do, how I'm using it as a superpower. You talk about finances. You listen. If you need to know about stewardship, period, whether it's from a church setting or from a civic setting, it doesn't matter. You can bring me in as a speaker, and we'll talk about this. And listen, you can do more for your community when having this information. And I'm going to just put it out there. If you're used to bringing Dave Ramsey in to talk to you about the debt snowball, which is actually going to cost each individual that uses that debt snowball on average of $50,000 to $70,000 more in interest, because it doesn't focus on the interest. So if you'd rather have something that is new, that is fresh, that is inviting, that has been created since then, okay, Dave Ramsey had his time. It was okay then, but this is more of an education that we need today. We need to understand what's really happening. So let's get back to this. So here's what we're looking for. Israel says, does this work in all countries? Yes, it does. Yes, it does. Now, our program, the way that it's written, uses this particular formula for dealing with the program. So we can't change formulas. So how do you know if our AI system works in your country? Just go to your bank website and go to the mortgage calculator on your bank's website in your country and put in a $200,000 balance at 6% interest for 360 payments, that's 30 years, and then calculate. If your payment comes out $1,199.10, our program works in your country. Okay? That's a quick way of knowing. All right, one more time. Put in $200,000 in a mortgage calculator from a bank in your country. Put $200,000 in, or whatever the unit of money that you use there. It doesn't matter. It's 200,000 units. Put 200,000 in at 6% interest for 360 payments or 30 years, and then calculate. If the payment comes out $1199.10, our program works. And if your country doesn't use pennies, then it'll come out just $11.99. All right. So that's how it works. All right. Israel, thank you for that question. Anybody else has a question? Please put it in the chat. If you want to come to our stage, you actually can see the link. Click on the link, and then it'll bring you into StreamYard. You'll have to leave your whatever app you're on and come into StreamYard to be on stage with us. You don't have to be on camera. You can just be on audio if you want to ask your questions live. All right. So let's get back to this thing. Let's get back, because I'm getting down to the crux of it. If you understand this part, then you'll understand why I like 7% interest rates. And I've got a surprise for you. There is a mortgage that's even better than the high interest rate mortgages. And it's going to be something that you never heard of. We're going to be talking about that next Friday. I'm going to listen. I need you to hang around here so that you can hear what is the very best mortgage available to us today. The very best. And I'm going to be talking about it next Friday, but I'm not going to share it with you now. Not going to share it with you now. We just gave you a little flash. Okay. So we're going to bring it out to you in just a few minutes. So hang around for a few more minutes. All right. So here's what we got, ladies and gentlemen. Here's what's happening. So now that we found out, how can I give the bank back their money? All right. If I can give them $2,456 and a penny all at once, guess what? All of that goes to my deficit, and I'm not discounted one penny. I'm not discounted one penny if I give them this much money. This is why we don't put large down payments on loans. Don't ever put a large down payment on a loan. Use your money to give to the bank strategically so that you can fill up your deficit faster and cheaper, and you can do it with a smaller rate of change and small numbers. So watch this. If I have $10,000, I could have put down on this mortgage, but let me hold it back. By putting $10,000 as a prepayment on this mortgage, look what happens. I knock off 45 payments and it saves $43,000 in interest. Why? Because I can divide more of those smaller payments into the $10,000 because I have small payments to work with. Okay. I still have $200 payments to work with on line 45. If I lower the interest rate, if I go down to line 45, look at this. Go down to line 45. Look, $300 payments. Fewer payments can go into $10,000. So, in fact, look here, it takes this much to do the same work. When I need you to understand this. When you work with us, we will teach you why you want the opposite of what banks are doing to you. You want the opposite. In fact, you're taught to get the lowest interest rates. You're taught to get the highest payments you can get. You're taught to get the highest rate of change you can get. But all of that helps you to stay in debt longer, and it ends up costing you more interest overall because of what you could be doing, learning how to prepay and killing a lot of interest. So here's what we're going to do. We're going to go back and look at this thing and see if that's what $10,000 could do. Look at that. $10,000 because of my small payments. All of that money can go to fill up my deficit and not be discounted one dime. If I pay on my own schedule, and that's what is fantastic about learning how to read this thing. If you like the idea of giving the bank money so that they can't discount your payment, okay? I need you to put this number in, and I'm going to tell you why. I need you to put this number in, okay? 84. Put in the number 84. Put in the number 84 right now. 84. Put in the number 84, and I'll tell you why you want this lower number and the higher interest rate. Put in the number 84, and you're going to see why we're talking about this. I want to give the bank money so that they can't discount my payment, so I can fill up my $200,000 deficit even faster. I want to get there faster. Okay. So here's what we're talking about. I see Ann put in her 84. I see Brenda Jackson put in her 84. Are these the only two that want to know? Are these the only two that want to know? Okay. All right. Well, listen, you may be, if you're on Twitter or LinkedIn, I won't be able to see it. You're 84 until after the show. It just doesn't show up here. Okay. I see Shelly. Shelly put in her 84. We can go ahead now. Okay. How would you like to use your current budget? How much money you're making now so that you can Teresa. All right. Therese Lee says 84. Come on, Therese. Put your 84 in there watching us on YouTube. So when you understand this thing, instead of 360 payments, how would you like it if you could use your current budget? Listen to me closely. How much money you're making now, and you can take a small amount of that money. It can teach you how to prepay your mortgage and other loans so that you can be out of debt in about 84 payments instead of 360 payments, where you can fill up your deficit in 84 monthly payments instead of 360 monthly payments. 84, 360. It's up to you. 84, 360. What do you want? I need you right now to go take a look at ice10k.com just go look at it today. Even if you don't fill it out, but please fill it out. Go to ice10k.com today. All right. And click on under ET's picture, get your savings and earnings report so that you can do 84 payments, not just on the mortgage. But now I have to qualify this. This is our average. Our average is 84. Some people pay off all of their debt in less than 84 payments. Some people take just a little bit more based on how their finances are structured. But it's basically 84 payments. Some go to 94 payments. Some have less than, some go to 75 payments. But man, whatever it is, you can know ahead of time, and you can know ahead of time, and you can know exactly how many payments, and you can know how much interest you can save. Okay. So now if there's 84 payments, let me show you something else. All right. Let's go back here. How much interest does the bank want on this loan? Okay. $200,000 loan. This is the wrong one. Okay. We're at 6% here. $200,000 loan. Okay. They want $231,676. Okay. They want to discount your payments by $231,000. That is crazy. When you add up all the discounts for the bank, they get $231,000 worth of discounts. So you got to pay more. A total of $431,676 is what it takes for you to fill up a $200,000 deficit. Okay. Listen, I want you, how many of you have a swimming pool? Okay. How many of you have a swimming pool? Here's what I want you to do. I want you to get your garden hose, and it takes a long time to fill up a swimming pool with a garden hose, right? But now, not only do I want you to use a garden hose to fill up your swimming pool, I want you to fill up a bucket and then take the bucket over to fill up your swimming pool. That's what I want you to do. Oh, wait a second. I don't want you just to use any old bucket. I want you to punch 10 holes in the bottom of that bucket. Try to fill it up and then use that bucket to fill up your swimming pool as water is draining out of it. That's exactly how the bank, think of your mortgage as an empty swimming pool. And when you get that swimming pool filled up, you're out of debt. You're trying to fill up a deficit right now with a garden hose and a bucket full of holes. That's what they're giving you. I'm showing you how you can take now a fire hose hooked up to a fire hydrant and fill up that swimming pool in 84 payments instead of 360, which means you pay less of a discount. And let me give you the number. Uh-oh, I just took that off the screen. Let me give you the number here. Okay. All right. So they want 231,000. Okay. 231,000. All right. We're going to do this. How would you like to pay around 75,000? Okay. 75,000 instead of 231,000. Okay. 231,000. Okay. Minus 75,000. Equals 156,000. How would you like to get a $156,000 discount? You get the discount instead of the bank getting the discount. All right, I need you to put the word discount in. Okay, no. I need you to put in my discount. Put my discount in the in the comment section right now. My discount, not the bank's discount. I want my discount. Put it in right now. $156,000 discount means more of your money goes to fill up your deficit. Less go. Look at here, Brenda. Come on, Shelly. Come on, Brenda. My discount, not the bank's discount, my discount. You deserve to get the discount because what I'm telling you is the truth. And here's what I don't want you to do. Please don't, because all you're going to do is get frustrated. Don't call your bank and ask them if this is true. Don't call your mortgage company and ask them if this is true. Don't call your realtor. Don't call your mortgage professional, the person that sold you the loan, your CPA, your financial planner. Don't call any of them and ask them if what I'm telling you is true. What you need to do is show them this video so that they can get educated. They can only help you with the education they have. And folks, stop asking people if this is true when they haven't had the education that only we provide. It's unfair to them. They have received a different education on how this works. So give them the videos. Go listen, share the link to the P.I.L.L method YouTube channel so that they can watch it and get educated like you're getting educated. But don't ask somebody who is uneducated in the P.I.L.L method if the P.I.L.L method works. They can't give you good information. Does that make sense? Please, they can't give you good information. So you want to be in the position where you can give the bank their money and you get the discount so that you can be done in 84 payments. Now, here's the good part. You can still live well while you're doing it. You don't have to live like a pauper. You can still go on vacation. You can still go out to eat. You can still have date night. You can still create memories with your children because it only takes a small amount of money to kill a huge discount from the bank. Oh my goodness. Listen, you don't need more money to overcome your deficit. You just need to stop giving the bank their discount. All right. So let's bring this back. $200 paid when you want to saves you nearly $1,000, cuts that discount of $1,000 off from the bank. They don't get that. Okay. It's less money. Okay. So, which means if that's about $1,000 I would save, $100 would save me about $500 in interest I don't have to give to the bank. All right. So $100 would save me $500. So $50 would save me about $250. You don't need much money. We're going to show you how you can use your current budget not only to kill the mortgage, But you can use your current budget to kill your mortgage, your student loans, your credit cards, and your car loans. And if you have a 401k loan, you can do that too. And if you owe the IRS, we'll lump that in too. All of it gone in about 84 payments. And you can still go on vacation and have a good time with your family. And you can also increase the amount of money you keep in savings. Don, that's just way too much to believe. Are you saying that I can be out of debt in about 7 years and still have a good time while we're doing have fun and increase my savings? Yes, you can. Why? Because they get less of a discount and you get more of a discount. We're going to show you how to get that. Does this make sense to you, everybody? Okay, we've been here at our hour and 5 minutes. Now, I want to show you what happens right now. What is going on right now? Take the information we just learned so that you can overcome your deficit with your mortgage and other loans a lot faster and cheaper. And I still have to reveal to you what we're talking about next Friday. I'm going to show you that a 7% loan can actually even work better. And then after that, I'll show you the very best loan of all. Would you like to know the very best loan of all? Oh my goodness. I'm going to show it to you in just a minute. So we're going to go here, all right, and duplicate the tab. Right now, interest rates are over 7%. So I'm just going to put in 7. Okay, 7%. Calculate that. Get rid of these ads. Okay, now, no. Okay, I'm gonna put in a new mortgage, $420,000. That is the median home price right about now across the country. Some are less, and some are more. But let's excuse me. Let's do 420,000 instead. There we go. And then I have to get rid of the ads again. There we go. Boom, they're gone. All right. So now look at what the bank wants. Okay, they're saying this is your rate of change on your payment. It goes from 344.27 to 346.28. But look at the discount they're getting off of your payment. Oh my gosh. Your payment here is $2,794.27. That is the payment here. That is the principal and interest payment. When you make that payment, here's the discount. The bank is discounting your payment by $2,450. And this you have to use to overcome your deficit. Wow. Now that you understand it, what's really going on, the real estate investor, okay, here's the real estate investor is doing this. Most of the mortgages, 60 to 70% of the mortgages, probably even more, depending on what's actually happening in the economy, okay? Why is it this way? Why is it this way? And I'm going to give you this link. We're going to pull this up. All right. I don't want that. Okay. We're going to pull this up so that you guys can see it. All right. And let me see here. There we go. All right. And close this. All right. Let's bring this over. Okay. This is an article. We're going to put the link in there for you. The American Mortgage in Historical and international context. We're putting the link in the chat so that you can have this for free. Okay. And I've highlighted some of the stuff that's in here. Okay. Highlighted some of the stuff that's in here. One of the reasons why this is important to know. Okay. Let me get my other notes here. Okay. Page 95. Okay, page 95 here. Okay. I want to point this. I want to point this out to you. All right. In response, because this was after the Great Depression. after the Great Depression, in 1929, after the collapse of the banking system in 1929, the Great Depression came afterwards. And a lot of people lost their homes, lost their farms, lost their churches, lost the building, lost their property because they had interest-only loans. They had interest-only loans. Yeah. And they had to have about 50 to 80% down. They had 50 to 80% down. And once they had that 50 to 80% down, then they had a variable rate mortgage, which was interest only. They made the payment was interest only payments. So every 5 to 10 years, they had to get a new or refinance the loan because none of their money actually paid down the loan. Zero. And so they could refinance the loan because every 5 to 10 years, the property actually gained value. So it behooved the bank to renew the loan. Because if they ever defaulted on the loan, the banks could kick them out and sell the property at a profit. Okay. So here's what happened after 1929. Most people lost their homes and their churches, their farms, or whatever their building was, whatever their property was, not because they couldn't make the payment, the monthly payment, the interest-only payment. They lost it because they couldn't make the balloon payment at the end of their term. And because they couldn't make the balloon payment at the end of their term, and the banks weren't refinancing anymore at that time because the property values were dropping, they lost their property. That's what happened. Okay. Now, after that, okay, in 1936 is when, or actually started in 1935, the government, I'll give you the shortened version, the government bought up over 1 million of these loans and reissued them to the people who had the properties, but they gave them a 20-year self-amortizing loan, the loans that we have today, meaning that every time you make a payment, some money goes to principal and some goes to interest. They got rid of the interest-only part and gave them a payment after 20 years. They could fill up the deficit after 20 years or 240 payments. That's what the government did. Now, I need you to focus on this part. In response to the calamities, the federal government began intervening in the housing finance market. It created 3 particularly important institutions. Here they are: the homeowners loan corporation, HOLC, the Federal Housing Administration, FHA, that you know today, okay, and the Federal National Mortgage Association, or Fannie Mae. That's what you hear today, okay? Now, listen to this part. The Homeowners Loan Corporation raised funds using government-backed bonds, used the funds to purchase defaulted mortgages from financial institutions, and then reinstated the mortgages. The HOLC changed the terms of the mortgages drastically, converting variable rate, short-term, non-amortizing mortgages into fixed rate, long-term, 20-year, fully amortizing mortgages. An amortizing mortgage is one where the principal is repaid over the life of the loan so that the borrower does not face a large lump sum payment at the end of the loan. Okay. And then the HOLC ultimately purchased, reinstated, and converted 1 million mortgages. That's what happened. Now, here's the other part I want you to see. Okay. Thus, the invention, 1936, the invention of fixed rate, self-amortizing long-term mortgages was above all else a response to a general financial crisis as opposed to a design for the promotion of home ownership per se. It wasn't for you that this was done. It was to save the economy. FHA adopted this form of mortgage to avoid the problem of people needing to refinance, which had clearly led to disaster. The way that they did it before, they automatically had to refinance after 5 or 10 years, depending on the term of the contract. They had to, all right? Or pay off the entire loan, which most people could not do. The combination of HOLC and the FHA represented a piece of early financial engineering that allowed illiquid financial institutions to become liquid again. It wasn't about you and me. It was about financial institutions owned by people who already have a lot of money. It was so that they could make more money. Okay? Now, I need you to read the rest of this, but here's what happened after that. The federal government got out. They said, well, we don't want to manage all these mortgages. So they started what was called a secondary market, and they sold these mortgages to investors. And two of the things that the investors were concerned about was default, meaning what if these people couldn't pay? Okay, because we're selling the mortgages to investors. And the other thing was prepayment, because we want to get all of our interest money. If listen, we're going to do this thing, I want 20 years worth of interest. Okay. This is why today you don't understand how mortgages work, because the same system of selling your mortgage, I don't care if you got your mortgage from Chase, I don't care if you got your mortgage from Bank of America, it doesn't matter. Most of those mortgages are sold within 1 week of you getting your mortgage. In fact, some of you may want to call to find out who actually owns my mortgage now. Call your bank and you can ask them, and they have to tell you who actually owns my mortgage now. And they have to tell you. The investors own your mortgage now. And is it beneficial? You just tell me, is it beneficial for you to know how mortgages actually work in other loans when the whole system is based on selling your mortgage to investors? It's called mortgage-backed securities. Look it up, mortgage-backed securities. And if you want to know what people who buy mortgage-backed securities are concerned about, the two top things that they're concerned about is changing interest rates and prepayment. The two top things. If interest rates change, they're concerned, because if they buy a mortgage that is 4% and interest rates shoot up to 7%, they've got their money locked in to a 4% loan long term. They feel as if they're losing money if interest rates go to 7%. So for you and me, they said, well, why don't you just why don't you just buy the 7% and be happy with that? Okay. Don't worry about the 4%. You're still making money. Yeah, but we're not making as much. So what? The other thing that they're worried about is if you ever learn that by prepaying small amounts of money, you can cut their discount so that they can't charge you 360 times to fill up your deficit. That's what they're really afraid of, because they want that long-term interest money coming to them. They want it to cost you $400,000 to pay off your $200,000 loan. That's what they want. Okay. Here's what else they want. They want for this loan, $420,000 at 7%. Here's what they want. $585,937.20 worth of discounts from your payment. So it takes $1,005,937.20 to fill up your deficit, to fill up your empty swimming pool until it's filled up to the top. It's going to take 1 million buckets of water with holes in it, with the buckets with holes in it, trying to fill up that swimming pool. 1,005,000 trips to fill up that swimming pool instead of 84. That's what's happening. Do you want to continue trying to pay back your loans with a bucket full of holes, where you're consistently giving the bankers a discount so that you have to pay more money just to pay back the note you signed? Ladies and gentlemen, that's what's going on here. When do you want it to stop? Oh my goodness. We're getting ready to do some marvelous things here next week. Oh my goodness. All right. I'm going to, let me see here. Where am I? I got to get my other notes up here. We're going to talk about the shows for next week, starting on Wednesday. Okay. Wednesday show is how to pay off your church in 7 years, 5 to 7 years. Okay. How to pay off your church in 5 to 7 years. How would you like that? If your church has a debt on it, how would you like to know how you can pay that church off in 5 to 7 years without extra giving from the members? That is a replay we're going to bring back to you on Wednesday. You want to see that, okay? On Friday, here's what we're going to do. I need you to go back. Remember that article I just showed you? This one here? Okay. Oh, this is going to be good. This is going to be good. Remember this article I read to you where the government said that these interest-only loans were the cause of the problem? And now we're going to go into self-amortizing loans? Did you realize that, remember, when you have a small rate of change, the smaller the rate of change, the more control you have over the loan? Well, with an interest-only loan, there is no rate of change. The smaller the rate of change, the better. How would you like to know that the best loan is actually no rate of change and you can create your own? You have more control over your mortgage if you get an interest-only loan. Put it up. This is why I love interest-only mortgages. I love them. I absolutely love them. Why do I love interest-only mortgages? Listen, I'm going to oh my gosh. I love interest-only mortgages because you are in control of the payment. Okay. So I'm not going to give away any of the details right now, but you want to see, if you can't be there Friday at 7 a.m., okay, make sure you catch the replay because it's going to stay up forever. We're going to go from a small rate of change to no rate of change. And I'm going to show you how powerful an interest-only loan can be. These people had it good until the government came in and says, we're going to make it better for you. Anytime banking makes it better for us, it's always worse. Anytime banking makes it better, it's always worse. Do the opposite. And I'm going to show you the numbers why I love an interest-only loan. And next Sunday, oh my goodness, next Sunday, How would you like to be able to be a mortgage loan broker? How would you like to sell mortgages and make a lot of money and you don't need a license? I've got a special guest coming in next Sunday, and they're going to talk about how and they're going to going to give you free information, and you can start the very next week making money from selling mortgages with the information that's going to be provided. No license required. Okay? How would you like to be able to do that? We're going to be talking about that next Sunday. Oh my goodness, folks, I'm just so excited about this information. I'm just so excited about what we do. It is amazing when you understand what's happening, and now you know the reasoning behind why the banks don't want you to know what's really going on. When you make that mortgage payment, all that principal and interest goes to the note holder. The amortization schedule just figures out how many payments you have to make. That's what the discount does. That discount on for your payment says, oh, it's going to take you 360 payments to fill up your swimming pool with that bucket with the holes in it, instead of hooking your hose to a fire hydrant and filling up your swimming pool so that you can get to fill up your pool, fill up your deficit with 84 payments instead of 360. Here's the last piece. Not just the mortgage, but pay off the mortgage, the student loans, the credit cards, the car loans, everything in about that much time, and live well while you're doing it. I don't care what Dave Ramsey says. I don't care what Susie Orman says. When you do the math, that's how it shakes out. I can live well. We can go on vacation. We can have a great time. There's money to spend on the family. There's money to kill interest. And there's still money left to increase my savings if I want to put money aside to grow our wealth. There's going to be money for all of that when you understand I don't have to keep giving the bank huge discounts. Okay. If you've learned something today, put some fire emojis in the chat. Okay. Put some fire emojis in the chat. Okay, Brenda Jackson, I see you in capital letters. I see you. Come on. Put some fire emojis in the chat. If you learned something today, stop giving the bank discounts. Get the discounts for yourself on all of your loans when you know how. Listen, one more time. We got to bring it back. We got to bring it back to you. Come on, Shelly. I see you. All right, Teresa. I see you. All right. So, folks, can you get your savings and earnings report today? Stop giving banks the discount. And here's what's going to happen. Okay. Here's what's going to happen. I need you to know this. When you use our system, we don't just give you any old discount. We're going to give you optimized discount. We're going to give you mathematically the largest discount that you can receive. You're going to pay the least amount of money going to interest, going to the banks. Okay. You're going to get the biggest discount available to you mathematically, because we're going to tell you how to give the bank back their money. You're going to give them the least amount of money in the right month, on the right day of the month, and attack the right loan so that you can get the biggest discount per dollar applied. Every dollar is now going to work its absolute hardest because you have a computer system that tells you exactly what to do with your dollars to get the most out of them. And when you're leveraging the right way, you pay the least amount, not the most. You pay the least amount of money to get the greatest benefit in discounts for you and your family. So less of your money gets discounted. More of your money fills up the deficit of that loan that was created for you. I'm telling you, The old way of thinking about the money is out. The new way of thinking about money is in, and I need your help. Here's how I need your help. I need you to help me to share this information. Here's what we're going to do. I want to show you this right now. If you want to help, go to ice10k.com. Go down to where it says become an affiliate right there. Become an affiliate and fill it out. Okay. When you click on become an affiliate, it takes 15 seconds. Full name, phone number, email, and how you want to get paid. An affiliate can make between $300 and $3,000 a month. And all you have to do is share the videos from our YouTube channel. Call people back after a couple of days and ask them if they want more information. If they want more information, then you just go to ice10k.com and scroll down under my picture here, right here. Scroll down under my picture and click on refer a friend. And this is the information you fill out, not them. You fill it out. If they've watched the videos and they want more information, please don't send me anybody that hasn't watched the videos. Okay? Don't do it, because they have to see the videos to know that this is possible. Because we have a head full of Susie Orman, we have a head full of Dave Ramsey, and so they need to see the videos first to know that that stuff doesn't work anymore. Okay? They need to see the videos first. But once they watch the videos and they want more information, you fill this out. Put in their name, put in their phone number, put in their email address, put in their zip code so we'll know when to find them. And then what are you going to do? You're going to put in your name and phone number so that we can link this to you. And you're going to give us some information about them. When's the best time to call? Tell us a little bit of how you know them. All right. Put some information in there so that when we call them, we'll have something to talk about. When they become a client, we pay you. Send us 5 in 1 month. That's a total of $3,000. Okay. Send us 1 is worth 300. But what would 300, 700, $1,200 a month, would that make a difference to your bottom line? Oh my gosh. 300, 700, 1,200. Listen, the more you send in, the more you get paid. All right, let's talk about it. All right, let's do that. So become that, because I need your help. I can't talk to everybody. I need your help in sharing our YouTube channel with all of this free content on there. Nobody else is teaching it. Do you know if somebody else was teaching it, they would charge big time money to learn what you've learned today? And you got it for free. So as a payback for getting it for free, share it with somebody else. That's all I'm asking. All right, let's get out of here, folks. I want to thank you for being here today, getting this information on what's happening with your money, on really learning what's happening when you pay a mortgage payment. Okay. You're not there getting the interest and you're getting the principal. You're paying back a deficit and they're getting a big discount, which causes you to make more payments just to pay back the deficit, just to fill it up. Keep that in mind. Keep that visual in mind. Filling up a swimming pool with a bucket with holes in it. That's how you're paying back your mortgage today. If you want to know more and know better, make sure you're here next week. Oh man, and I'm going to show you how you can get a interest-only loan and take complete control not only of your mortgage, but with an interest-only loan, you're in complete control of your monthly payment. You can change your monthly payment anytime you want when you have an interest-only loan. I'm going to show you next week. All right. So folks, listen, enjoy the rest of your Sunday today. All right. We had a very good time with you today. I'm looking forward to coming back and giving you more information. Thank you for everybody who participated, who get money in the chat, who participated in the chat, all of that. Share this with your friends and make sure that you subscribe, make sure that you share, make sure that you comment, and make sure that you like the videos. All right. Okay. We'll be back here with a replay on Wednesday, but I'll see you next Friday when we're talking about the very best loan available in the world is an interest-only loan. Why I love interest-only loans. See you on Friday. Have a good day. Bye-bye, everybody. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.